Hey,
Yeah,
it's a great honor to be invited to speak to all of you tonight, to such a distinguished audience, albeit remotely. Um, Today, I'm going to talk about the transformational impact that central bank digital currencies will have on the global financial landscape. I agree with a lot of what my good friend Professor Si has said, but I'm going to concentrate far more on practical considerations rather than technology. And just to kind of briefly introduce myself, I held a lot of senior positions in the City of London, and I was appointed to a new position in 2002 at the London Stock Exchange as Director of Markets and Head of AIM. So I was in charge of all the primary and secondary markets in London and 80% of the overall business. So a lot of my time at the LSE was around applying technology to markets to make them more efficient. So I've actually got first-hand real-life experience of how technology actually impacts things and how transformational it can be. Um, since 2010, I've focused on my private interests, which are really centered on businesses which I believe represent the future, as well as making very good wine in Italy, which is where I am, not exactly where I am now, but the backdrop behind me. Um, I really wanted to start by saying that I believe there is a very strong possibility that a new generation of digital currencies, including CBDCs and properly designed stablecoins enabled by technology, will be massive drivers of change. That change will have huge impacts on commercial banks, um, as well as all sorts of implications for both domestic and international monetary policy. And it ultimately will, in my view, threaten the existence of some weaker domestic fiat currencies, and also severely undermine a lot of government's ability to utilize monetary policy as a policy instrument. But CBDCs, the key thing is they're going to bring huge, huge benefits in terms of efficiency, functionality, and what I think is the most important thing for people in the world, citizens of the world, which is financial inclusion. So they're going to bring massive benefits, but the disruption they will cause will have all sorts of both intended and unintended consequences. So I have a very, very simple agenda today. I was going to talk about what is a CBDC, which you all know. Secondly, talk about the motivation behind the creation of CBDCs and what are the key benefits. And those benefits will be different for different parties. Finally, I really want to go through what the practical hurdles are, which need to be overcome to ensure they actually get effectively implemented, and they are quite considerable. So, what is a CBDC? Clearly, this is very simple. It's really the digital version of physical cash. The key implication and difference and relevance really is that CBDCs will enable private citizens to have a direct relationship with a central bank, effectively holding their deposits with the central bank as an alternative to commercial banks, and that has a huge implication for the global financial system. Now, in terms of where we've got to date on CBDCs, we've seen a lot of progress. Um, Obviously, the Sand Dollar in the Bahamas was the first real CBDC. We saw the digital e-yuan trial in China, but that's not really a digital currency because it's not utilizing blockchain and it's not really a universally accepted form of payments. But the last three bullets are critical. All central banks, all major central banks, are exploring launching CBDCs. A lot of them are engaged in a lot more consultation and actual practical action. Even the Bank of England, I would say, is in that camp. But that's probably because of the potential real world consequences of CBDCs are a hot political issue for obvious reasons. Now, the final point here that a fifth of the world will have access to CBDCs within 3 years, I think, is a huge point, and it's not going to go away. So we've seen some progress today, but that progress is really accelerating. I should mention stable coins because I think stable coins, I believe, have got certainly ones properly constituted in terms of being properly designed, having proper reserve backing, being fungible with other forms of money, will be equally as effective as CBDCs. And I believe a lot of cryptocurrencies don't have the characteristics that fit that stablecoins can have in terms of fulfilling the functions of money, particularly being a trusted source of value and means of payment, particularly given the volatility and the valuation of a lot of cryptocurrencies and a lot of the kind of fraud associated with them. So ultimately, stablecoins could actually be more trusted as a monetary asset, given the pressure on some central banks to engage in activities like quantitative easing and what I call other forms of money printing to avoid short-term difficult political decisions. So I think the emergence of a number of high-quality stablecoins alongside CBDCs is actually a very good thing, because it actually promotes competition and ensures governments actually are not tempted to debase their currencies. It also obviously reduces overall systemic risk. So why are CBDCs so important to central banks? We need to understand, I think, their obligations and motivations. All major central banks have a duty to protect the stability of their domestic monetary system, and in most cases they have a duty to ensure consumer protection and promote competition. In some cases they also have political objectives. That depends on the country. Now what we're seeing today obviously is a massive trend to cashless payments, and China is a great example. In 2024, in 5 transactions were cashless, and that's been accelerated by COVID, especially for older generations. And you do have a systemic risk if you have over-dependence on private providers of payment systems. So CBDCs do provide security against potential system failures by, in theory, providing a fail-safe alternative. Now, the possible growth in mass adoption of non-bank, non-central bank digital currencies could also clearly, as Professor Syme mentioned, undermine the role of central banks in both domestic and global financial systems. And clearly Libra / Diem was a wake-up call, and there will be also numerous alternatives to central bank currencies going forward. So central banks have very clear defensive reasons for launching CBDCs, partly to guarantee better payment systems, but also to more robust payment systems, but also to ensure they control monetary policy. So it is all about control, but it's not all around narrow financial stability objectives. There are tangible benefits which I think are very important from CBDCs, including speed, reliability, functionality, the security from having a distributed ledger technology which with a no central point of failure. Obviously the costs of printing, storing, distributing physical cash are enormous. I think in 2007 in the EU spent 50 billion on cash as an asset, which is a ridiculous amount of money. We all know about audit trails and preventing tax evasion, but beyond that, CBDCs do play a huge role in promoting financial inclusion. There are billions of people who are unbanked in the world, particularly in poorer countries, and through providing mobile wallets which you can access using phones or more innovative solutions, you can solve a lot of those problems. You can also use CBDCs as a policy instrument. You can do things like implementing negative interest rates, which you can't do in a cash-based system, and you can actually target funds when it comes to disaster relief and other scenarios. And obviously CBDCs can have wider policy objectives, and we've already talked about currency wars. I mean, I do know obviously China wants to replace the US dollar as a global reserve currency. I could spend many hours, we could spend many hours debating that point. All I would say is that I think the dollar's relative position is actually in terminal decline, and that's not going to change whatever we talk about. This slide talks about some of the more general benefits, ranging from massive improvements in speed, security and cost of making payments for citizens, to greater security for their bank deposits, potentially if they leave their money with a central bank. However, in places like the United Kingdom, you have £80,000 of bank deposits guaranteed in commercial banks, so that offsets a lot of the risk. Systems resilience is also very good for people, and clearly financial inclusion is a massive positive for global citizens. And obviously programmable money, we talked a lot about programmable money, etc., brings a lot of benefits to consumers. So as I said at the start, digital currencies can bring huge benefits, but they also cause real disruption to financial systems. And there are a number of very practical issues which we need to resolve before these currencies become mega successes. Now, an issue preoccupying a lot of central banks is the impact on commercial banks. Now, if consumers decide to transfer deposits out of commercial banks into central banks, and we're talking about a lot of money here, if you have 16.8 trillion of money held in deposits in US commercial banks, that has huge implications for the liquidity for commercial banks. Okay, they need to find other much more expensive sources of liquidity. So their role in funding loans, which they fund $15 trillion of loans in the US, it could actually be constricted. They also obviously play a role in money creation, collecting deposits and making loans. And we could see, I think, an end to fractional reserve banking as the source of most lending. And we could see, therefore, the break between the link we have now between the extension of credit and the creation of money. And that's been a core plank of the banking system. Now, I don't think commercial banks should be a protected species at all. And their ability to rely on central banks as kind of lenders of the last resort has led to all sorts of excessive risk-taking by banks and led to major failures, such as we saw in 2008. So we shouldn't be protecting them. We're seeing plenty of non-traditional lenders emerging, using technology, entering the loan market, and capital markets also will become a lot more efficient as new entrants embrace technology. One thing which I think is very, very interesting is some of the large exchanges will find out to their cost if they don't properly embrace technology very soon, that their positions will gradually be under threat and their systemic position in the markets will disappear. And I know this very, very acutely. And I'm working on a few alternatives to global exchanges. I think places like the New York Stock Exchange will not be in the same position if they try to maintain legacy systems for long. Anyway, but that's for a future conversation, which I'd love to have with many of you. So anyway, so the traditional role of banks could contract significantly unless they actually do a better job, they get more competitive and they innovate. But whichever way you look at it, it actually is good news for consumers, both private and corporate. So that's the impact on central banks. Technology is really important in this, because if you don't have the right technology infrastructure, for instance, a CBDC using a blockchain which isn't properly quantum safe, that would obviously be disastrous. And the problem is, historically, governments are not very good at technology. Well, probably in China it might be different, but certainly in the West, I could give you hundreds of examples of where governments have sponsored technology. It's all gone very badly wrong. I've just given you two examples in the first bullet here. But the problem is, if they use external providers, you can potentially create vendor dependence. So you have to have some kind of solution where you have a partnership with external technology providers with proper protections put in place. There are major issues around data protection with digital currencies. Although we know some governments take a far more relaxed view concerning the treatment of private data, it is a very important thing. So the transfer of data in every digital transaction has to take place, obviously, in a secure environment. And this has become more of a challenge given the amount of data generated through new forms of digital money. So, and some intermediaries obviously have business models where they're trying to actually use data like spending patterns to monetize their business model. Now that requires very strict controls and real consumer choice. So maybe consumers should properly permit their use of data for some kind of financial incentive. And I think one day what we will see is a digital marketplace so we can sell our rights as consumers, and that will solve that problem. And also there are obviously legitimate regulatory reasons to access data which have to be properly managed. So data is a very significant issue. I know a lot about regulation because one of my favorite jobs at the London Stock Exchange is dealing with global regulators, and they can make markets work or they can destroy markets. Now, the wrong type of regulation could clearly seriously damage the success of digital currencies. For instance, regulation protecting the vested interests of commercial banks through limiting retail access to CBDCs. To my mind, though, the good news is that regulators understand that preventing change is not really a viable option, especially given the overall benefits of change and also the opportunity for consumers to access, well, even if regulators don't do things, consumers potentially could access emerging private sector currencies and possibly CBDCs from other countries or baskets of them. And I'll discuss that in the next slide. So regulators can't really turn back the tide of change. They can slow things down, but they're not going to change it. We've already covered some of this, but I think this is fascinating. So the international aspects of central bank digital currencies could be the most transformational thing we're talking about here. So at a very basic level, digital currencies dramatically reduce the costs of and efficiencies of cross-border, and improve the efficiencies of cross-border payments. And obviously, Bob Blower is probably one of the greatest experts on this, so we can listen to his erudite talk later. But at a more strategic level, they have all sorts of implications for domestic and international monetary policies. If we envision a world where capital flows aren't controlled and domestic residents can hold new forms of non-domestic digital money, I think we can really predict a future where increasingly citizens switch out of domestic assets in some countries with poor monetary policies into new internationally traded safe assets, including potentially things like synthetic baskets of CBDCs that Professor Sy mentioned. Now, this could lead to what I mentioned in my introduction. That's the demise of weak currencies and seriously undermine the ability of some nations to use monetary policy. So nations will need to cooperate to ensure the launch of a CBDC in one country, for instance, doesn't impact the financial stability in another country. But there is also a strong possibility we could see competition rather than cooperation. And that has all sorts of ramifications. At a lower level, customer inertia could slow the emergence of digital currencies. Okay, now I'm going to move to, sorry, I've already covered that one. This is quite an important practical issue. People like actually holding physical cash for a variety of reasons, and they're not all nefarious. And obviously low interest rates reduce the opportunity cost of storing cash under a bed. Actually, I don't know if you know, the most common place to hide money is actually in a refrigerator. So if I leave you one thought, that's the most interesting thought tonight. And some people have got legitimate concerns over digital assets and their vulnerability to cyber attacks and invasion of privacy. So there are things which are going to hold back the movement to central bank digital currencies. Now, obviously, people already hold money in commercial banks, and the incentive to transfer this to a central bank and hold digital central bank money is constrained by two things, I think. One is what I already discussed, that in some cases, there are bank guarantees. Obviously, in the UK, the 80,000 guarantee, there are guarantees in the US, so there's no point to transfer money from your commercial bank if the incentives aren't there. And the other point is, do people really trust central banks? Okay, and a lot of cases, it's true to say central banks haven't done a great job, particularly when they're politicized. So the Bank of England assumes 25% of bank deposits will transfer if a digital pound was launched. Clearly, that percentage can vary dramatically given the level of trust or lack of trust in central banks around the world. So theoretically, central banks can deliver risk-free money. But I do think, given the actions of central banks in the interest of wider economic policy objectives, they can erode the value of money, so they wouldn't necessarily be trusted. So they might not see a central bank digital currency as the best place to keep their money in some cases. They might look at other assets, including private currencies or even CBDCs from other countries to maintain the value of their money. So there are all sorts of practical considerations which are going to limit the movement to digital currencies. However, I don't think it's going to stop. It's just going to be slowed. So in conclusion, I don't know all the answers. And as you can understand, there are obviously a multiplicity of factors impacting the successful launch of digital forms of money, including CBDCs. However, I do think the emergence of digital currencies is inevitable. And with the decline in physical cash, the relationship between private citizens and central banks could be very different. It will be very different. The role of commercial banks has to change, and those that transform themselves and embrace technology and properly manage risks and become properly customer focused can still play a role, but many of them will see their systemic importance diminish very quickly. Change obviously can be slowed by some of the things I talked about, but ultimately the interests of global citizens and promoting financial inclusion, which is absolutely critical, those things will prevail, and digital currencies will have a huge role. I've already mentioned domestic monetary policy. That will be a huge issue, and we will see the demise of a lot of fiat currencies. And I think the final point is, I remember it being at university at the London School of Economics in the 80s and talking about a world of competing currencies. Certainly reading Hayek in great detail, he introduced the concept of currency competition 50 years ago. So today, actually, we're seeing technology really make it happen. So thank you for your time, and I'm delighted to answer any questions.
I do have a question regarding you talking about both you and Professor Tsai talking about this competition, right? He talking about the currency competition from different sectors. You talking about the competition between the CBDC and the private. Can you give us a little bit more details? So what kind of competition there will be, in which area, and how will be the result?
Well, I'm seeing in terms of within CBDCs, okay, if I'm able to hold a central bank digital currency, I might not necessarily hold, if I'm in a country where I've got not much faith in the domestic policies of the bank, and I'm worried about them printing money, I might want to hold my banking assets in somebody else's central bank digital currency. Okay, so that means that has huge ramifications for the country you're in, because nobody wants to hold their currency, so their economic power is significantly reduced. But also, it's not necessarily the fact that it's going to be competition between central bank digital currencies, single central bank digital currencies. You could have the emergence of large stable coins, okay, or baskets of stable coins run privately, and you might well have more trust in them, because we don't necessarily trust our central banks, than a central bank digital currency. If we actually saw that happen, we will see a massive shift in the economic power of individual central banks. But I think overall, the fact that you're going to have competition actually leads to a huge incentive for central banks and governments not to abuse their powers when it comes to debasing their currency. And people would rather actually probably have money within a fiat currency in a digital version. And if the central banks are operating in the right place, they have got a huge store of kind of credibility, I think, with a lot of citizens in most developed countries. But what we've seen recently is that is beginning to diminish. So I think the competition thing is good, because it actually means that we don't end up with banks printing money and massive inflationary pressures.
Mm-hmm. Thank you.